Walk through downtown in almost any American city after 5 p.m. and, just look up. Floor after floor of glass towers, dark, empty. Offices that companies are still paying rent on, but honestly, nobody shows up to. We all noticed it. We mostly just shrugged. Here's what we missed. Empty office floors aren't just a real estate problem. They're a massive loan. And many of those loans are with your local bank. Banks hold trillions in commercial real estate debt, much of it coming due soon. That's why empty towers could threaten your bank and your money. Let's start with how this debt actually works, because honestly, it's nothing like a home mortgage. When you buy a house, you typically borrow for 30 years and slowly pay it off. A commercial office loan is built differently. A developer borrows a huge sum for a short term, often 5 or 10 years, and during that time pays mostly interest, not principal. When the term ends, they don't own the building free and clear. They owe nearly the whole amount in one shot. So they do what they always plan to do. They refinance. They take out a new loan to pay off the old one, and, well, the cycle continues. That system works on one condition. The building has to be worth enough, and rates have to be reasonable enough, for a new loan to cover the old one. For decades, both were true. Offices were full, values rose, money was cheap. Refinancing was basically a formality. Then, almost overnight, two major things happened at once. First, remote work emptied the buildings, transforming the heart of American downtowns. After 2020, companies discovered they didn't need every floor, or, honestly, any floor at all. The shift was sudden and dramatic, as businesses realized they could operate just as efficiently, if not more so, with their employees working from home. The national office vacancy rate climbed past 20% in 2025, a record high, higher than anything seen in the 4 decades the data's been tracked, and a number that sent shockwaves through the real estate industry. This new peak beat even the early 90s vacancy crisis, which was previously considered the worst in modern memory. And that's just the average. In the hardest-hit downtowns, like Austin and Seattle, vacancy ran north of 27%, leaving entire blocks eerily quiet. A half-empty building brings in half the rent, and sometimes even less, as landlords scramble to fill space with short-term tenants or offer deep discounts. And a building's value is based on the rent it produces. When rent falls, so does the building's appraised value, often dramatically. So values didn't just dip. In the worst-hit central business districts, prime office towers lost roughly half their value from the peak, erasing years of gains almost overnight. Some individual buildings sold for 70 to 80% below what they last traded for, shocking investors and city officials alike. Second, the Federal Reserve raised interest rates fast, in an effort to fight inflation and cool the economy. The loans were cheap when they were signed, with low monthly payments that made even expensive buildings seem affordable. The new loans, to replace them, are far more expensive. Monthly payments can double or even triple, squeezing owners already struggling with lower rents. Put those together and, well, you get the trap. A perfect storm of falling income and rising costs. A developer who borrowed against a building worth $100 million now owns one worth maybe $60 million. A staggering loss on paper and in reality. And the loan is coming due at a much higher interest rate, making refinancing nearly impossible for many. The bank looks at that half-empty tower and won't refinance the full amount, seeing too much risk and too little value. The developer can't cover the gap, and with no other options, faces a tough decision. So they do the only thing left. They walk away, leaving behind years of investment and effort. They hand the keys to the bank, surrendering ownership and responsibility for the property. And now the bank, your bank, owns an empty skyscraper it never wanted, worth far less than the loan it made against it, and facing an uncertain future in a changed world. Here's where the story shifts. What started as a real estate problem quickly becomes a banking crisis, with consequences that ripple far beyond empty office towers. The biggest banks in America, the household names you see on skyscrapers and in every city, actually hold relatively little of this office debt compared to their total assets. For these financial giants, commercial real estate is just a small slice of a massive diversified portfolio that includes everything from mortgages to global investments. But the real concentration of risk sits with small and mid-sized regional banks, the ones on your local Main Street, not Wall Street. By some estimates, these smaller banks are responsible for holding close to 70% of the commercial real estate loans that appear on bank balance sheets, a staggering share. Yet, when you zoom out and include government agencies, insurance companies, and the bond market, banks as a whole actually hold less than 40% of all commercial real estate debt. In other words, the portion of this debt that lives inside banks is concentrated overwhelmingly in the institutions least able to absorb big losses, the smaller, less diversified banks. Even the Fed chair has acknowledged this risk publicly, warning that the real danger isn't with the giants, but with the smaller and medium-sized banks scattered across the country. That's the contradiction nobody saw coming. The risk isn't where everyone was looking. For years we worried about the giant, too-big-to-fail banks. the ones whose collapse could shake the entire global economy. But this time, the real threat is lurking in the small ones. The community and regional banks that fund your local businesses, your mortgage, your auto loan, and the backbone of many towns. And we've already had a preview of just how quickly things can unravel when confidence disappears. In 2023, a handful of regional banks collapsed in a matter of days, marking some of the largest bank failures in U.S. history and sending shockwaves through the financial system. Those particular failures had their own unique triggers, but they exposed a deeper truth. A regional bank can look perfectly healthy right up until the moment confidence cracks. And then, almost overnight, it's gone, leaving customers, employees, and entire communities scrambling to pick up the pieces. So, who actually gets hurt when these office loans go bad? It's not just the people in those empty buildings or the companies that own them. Trace the chain, because it runs straight to your door. The effects ripple outward, touching people in places you might not expect. When a bank takes losses on bad office loans, it has less money. That means less cash on hand to support the rest of the community. A bank with less money does one thing reflexively: it stops lending. Lending is the lifeblood of local economies, and when it dries up, everyone feels it. So the small business in your town that needs a loan to expand gets turned down. Dreams are put on hold, and growth stalls. The developer who'd build new apartments can't get financed. Projects freeze, jobs disappear, and housing shortages can get worse. Credit tightens across the whole community, even for people who never went near an office building. Everyday families and workers feel the squeeze. If the losses are bad enough, the bank itself can fail. That's when the trouble really spreads. Your deposits are insured by the FDIC up to $250,000 per depositor, per bank, per ownership category, which offers a safety net for most people. So most ordinary savers don't lose their cash. Their money is protected, and they can breathe a sigh of relief. But the disruption is real. Businesses that banked their scramble, trying to figure out their next move and keep operations running. Loans get called or sold, and confidence in other small banks wobbles. Fear is contagious, and uncertainty spreads quickly. One failure makes depositors at the next bank nervous, wondering if their money is safe or if they should act fast. And a nervous depositor is one phone tap away from pulling their money. That's how a single problem can become everyone's problem. There are winners, though. Big banks with strong balance sheets get to swallow the weak ones cheaply, consolidating the industry into fewer, larger hands. Distressed asset investors circle, buying those empty towers for pennies on the dollar, betting they can convert them to apartments or simply wait out the storm. In every crisis, the patient and the liquid get richer. And the deepest risk is the one that's hardest to price: time. This isn't a crash that hits in a single afternoon like a stock market plunge. These loans come due in waves, year after year, with hundreds of billions maturing annually for the next several years. It's a slow bleed, not a heart attack, which is exactly why it's so easy to ignore until a bank you've never thought twice about suddenly makes the news. A fair word of caution before you panic. Plenty of analysts argue this stays contained. Office is only about 15% of all that CRE debt. Many of these loans were conservatively underwritten, and regulators have been leaning on the most exposed banks for 2 years now. A slow, manageable workout is at least as likely as a crisis. The point isn't that collapse is coming, it's that the risk is real, concentrated, and sitting closer to home than most people assume. Which brings us back to those dark towers downtown. They look like someone else's problem, a developer's bad bet, a city's empty core. They're not entirely. They're a promise to repay money, and some of those promises were made to banks holding more of these bets than they can comfortably afford. The emptiness you can see from the sidewalk is connected by a thin chain of loans and refinancing and confidence to the money you can't see, the money sitting in your account right now. The skyscraper doesn't have to physically collapse to do damage. It just has to stay empty long enough for the loan against it to come due. And across America, the clock on those loans is already running out.